It's been a bit of painful, well, autumn or indeed year when it comes to both stocks and bonds from a global perspective. Laurie, are you getting any views on why you might be optimistic in this current stance?
Well, it's hard to be optimistic until we know where the Fed trajectory is going to end. As long as you don't know where the terminal rates are on short-term rates, it's really hard to price any other asset class to know whether there's value there. And I think that's a lot of what we've seen play out in the tensions over the last several weeks, is the market getting some signals that perhaps the Fed can start to ease off its hawkish stance, but then that's followed by other data that suggests that it can't. And as long as you have that tension going on, it's a little too early to really jump full force into the markets.
Some of the concern, though, Laurie, also isn't just about the data points we're getting, but about that lagged effect of monetary policy. Right. And some people think, okay, well, 375 basis point rate hikes, that maybe we wait to see what that lagged effect is.
Well, you're absolutely right. And I think that is, again, one of the reasons why market participants are especially skittish, because many, including us, think that the Fed may have done enough and that they should take a bit of a pause here, maybe not to hike rates at all at their next meeting, but certainly to ease back off of those 75 basis point moves that they've been making, because it does take a lagged period before you start to see that transfer into the economic data.
What about the lagged effects of some of the liquidity challenges that we're starting to hear some conversations about as well, particularly within the bond market?
Well, as you noted, both bonds and stocks have been selling off. And the challenge is that while it's a little bit easier to think about where stocks might be valued, because you can tend to look beyond a recessionary period, if in fact we have a recession, and say, you know, there's some economic value that's going to be created through time. The question with bonds is a little bit more tricky, because it's really about not just are you going to get your money back if you look at credit and high yield and places like that, but really what is the value in the interim as the Fed continues to have this very hawkish dimension. And so there really hasn't been a lot of kind of classic buying yet, because people are in a wait and see attitude. They're getting plenty of yield from cash right now relative to where they used to be. So there's just no urgency about putting money to work in bonds.